Welcome to Jazz After Dark, everybody. How you doing out there? Hope you had a good weekend. You ready to get back at it here? We got a big week, actually. The Fed coming up with their decision here. And, of course, we are finishing off our tour of American whiskey here. American whiskey. Whiskey for people that understand that the principles that made this country great can evolve, but still keep this country great. I'm not going to do it to you again. I'm sorry. Once is enough. I hope you're having a good day. Tonight, we are sampling Westward Whiskey here, actually, and American single malt whiskey, supposedly butterscotch, the primary flavor. I definitely smell it there. Dried fruits, I definitely get that, and some cinnamon. Very butterscotchy. Oh, but fruity. Fruity on the finish there. Wow, I'm going to reserve comment for that one. Let that digest a little bit while we're talking here tonight, because the Fed is due to raise interest rates a quarter point, and they're going to. It's not going to change. They're not going to magically do anything different. It's already priced into the market, and we already understand that that's what's going to happen. The bets are already being made that that's what's going to happen, and those people are going to prove to be correct. Now, what's important about this one, this is a really, really cool thing, and I'll show you how we're the only advisor digging into this here, but I'm going to show you. So the end of a Fed rate cycle is important, and that's where we're going to be, right? They're going to raise a quarter point, and then I'm going to actually show you the language that they're going to use to sound tough still, but also tell people we're going to pause here. We're going to give it a little bit of a break. Now, the end of a rate hike cycle is important because it tends to be really strong for stocks. And so you might remember a ways back, we actually talked about the sector performance following the end of rate hikes. So we look at the S&P up here. 1984, we looked at the end of the rate hikes there and saw, okay, what was the performance going out a year? 1989, 95, 2000, the only year that was down after the end of rate hikes, that's the dot-com bust right there, 2006 and 18. So the last couple of them have been double digits. And in fact, if you take out only the one that was down, the median performance, if you take the median performance, it's 12%. 83% of the time, the stock market is actually higher at the end of, as you go through the end of a rate hike cycle. And so this one could be really important because this could be the catalyst that tells stocks, okay, we know now what it's going to cost to borrow for the foreseeable future, probably through the end of the year. If I had to make a bet, I would say rates stay this way through the end of the year, barring any major meltdown or anything like that. And so what that does for stocks is it allows them to go, well, we need to borrow money. Well, now we know what it's going to cost, and so we can determine that effect on our earnings. And it allows analysts to do the same thing. So in particular, we can go down sector by sector, find that financials have the best odds of being positive going through the end of a rate hike scenario. There's only one time that it was negative. It was a wash back in 89, but that has the best odds of being positive. The best median grower, you might be able to guess, was utilities, 5%. The worst are materials, energy, discretionary, and tech. Tech being one of the worst because they tend to borrow money and have to sort of offer debt. And that's going to cost them more. So it's going to eat into their earnings, and you can only jack up prices so much. And that's a really oversimplified way of explaining, finances 101, right? Same thing with you. If it costs you more to borrow, you have less disposable income, right? So really important for the markets here, if you're one of, like me, and you're a market geek and you like looking into this stuff. Utilities, you probably could have guessed because, utilities are essentially debt. They borrow to survive. And so now that utilities are able to predict very accurately what their rates to borrow will be, they can factor that into how much they charge us for electricity and all that good stuff. It also helps them determine how much they may want to improve or do maintenance or maybe even expand, although that's not such the case for utilities. So really important to understand that the end of a rate hike cycle is pretty positive for stocks, in particular the S&P and maybe the other indices as well. Maybe not so much the NASDAQ, right? Because it's heavily tech, and we know tech doesn't do so well. I'm going to go. I'm going to say that's a fun whiskey right there. That Westward whiskey, that's a fun one. Probably good for those of you that like things more on the fruity side. Definitely spicy still. But that's a good one. That is a good one. I don't know that I would drink a lot of that, which is probably a good thing. I'd give that a solid C plus, just for me personally. Now, like anything else, in order to understand what the Fed's going to say, well, any good historian and market research or statistician would look back and see what happened in previous rate hikes. Did they talk tough and say, look, this is it for now, but if we have to, we're going to go higher? Or did they say, this is good, we're happy, we're going to pause? So let's take a look, because I'll show you how this is going to play in. Back in 94, they said the Federal Reserve will continue to monitor economic and financial developments. This is basically in everything that they say, to gauge the appropriate stance of policy. That first sentence is a given. It's going to be there in some fashion or another. But these actions are expected to be sufficient, at least for a time, to meet the objective of sustained non-inflationary growth. So they say in this case, we're good. We think what we did is a winner, and we don't need to do anything else. There is no way the Fed is going to say that this go around. Today's increase in the federal funds rate back in 1999, together with policy actions in June and August, firming conditions more generally in the United States financial markets over the course of the year, should markedly diminish the risk of inflation going forward. As a consequence, the direction the Federal Open Market Committee, FOMC, adopted is symmetrical with regard to the outlook for policy over the near term. A lot of fancy words to say, what we did, we think we did well, and in the near term, we think we're going to be just fine. So they weren't being aggressive, hawkish. They weren't saying, we'll come back and we'll fight this thing if we have to, right? In 2000, this includes a few updates as well, against the backdrop of our long-term goals, which was price stability and sustainable economic growth. Notice it says, and of the information. They changed it from currently to already. This was from their previous one to their last one, already available. We believe that the risks are weighted mainly towards conditions that generate heightened inflation pressures for the foreseeable future. In other words, they're saying we're not forward looking. We're saying that the data that we already have indicates that we basically did what we needed to do. No chance they say that this time. How could that be, right? They're used to saying this. They said the extent and the timing of any additional firming that may be needed, rate hikes there, to address these risks will depend on the evolution of the outlook for the inflation and economic growth. So in 2006, they say, well, we're going to raise rates here, and any additional rate hikes really will need to be warranted. We're going to need to see that we overdid it. That's essentially what they were saying there. And come to find out, they overdid it. That's what happened there, if you're a historian. And in 2018, after a small string of rate hikes there, the committee judges that some further gradual increases in the target rate for the Fed funds rate will most likely be consistent with our objectives. In other words, they said they were trying to tell you they're done here, but gradual increases in our target rate, in other words, raising rates more, will most likely be consistent with what our goals are, meaning we're done for now, but we're going to come back, right? There's going to be some point where we have to come back. So what I did is I said, okay, let's take all of that. There's tons of analytic models that you can use, lots of analyst models. We happen to use one of them. And here's what we have. This is what the Fed's going to say. I'll bet you that it's within just a few words of being accurate. We'll check it out, see what happens. The committee, they always say this here, this first sentence. In support of these goals, the committee decided to raise the target range of the Federal Reserve rate. Now this is taking the black, is taking what they previously said, and the red, either struck out or underlined, is showing how it's going to change. These are the guesses. So we're taking the target range up, which means this new range would warrant, meaning they're going to do a 0.25% rate hike. So they're going to put it from 5 to 5 1/4. In other words, go from 4 3/4 to 5, so that'll be a 1/4 point hike. They're going to get rid of, the committee will closely monitor incoming information and assets and implications of monetary policy. They're getting rid of that to tell you, we're stopping here, right? That's their way of, they're not going to say, we are pausing rate hikes, right? So us layman people out there that are waiting to hear something, we're not going to hear those words. What we're going to hear is, this is gone now. Now they're going to say the committee anticipates that the stance of monetary policy will most likely be sufficiently restrictive, meaning we've tightened as much as we need to return inflation to that 2% range over time. That might be the one word that they put in there. Now, they're taking out those words that say some additional policy firming may be appropriate, right? So if we go back a second, this is their way of saying more rate hikes are coming up here. Now they're going to strike that and they're going to say the stance will most likely be tough enough to get our inflation back down. But we're going to closely monitor the information and assess the implications for monetary policy. One other word they may include in there is the health of the financial system. One of the words. In determining the extent and timing of any additional increases in the target range, the committee will take into account cumulative tightening of monetary policy, which we understand is slow to respond to their overall monetary policy slow to respond to the economy, right? And inflation in particular. So what they're saying there is we realize that we're restrictive, we've raised rates, we're happy with that for now, but we are not going to stop this fight. We will take a look at the data that comes in, realizing that the rate hikes that we've done already, they don't show up every day. Like it's not going to show up the day after they raise rates. They say, okay, we realize it's going to take some time. We know that our data is lagging, so we're going to monitor that closely. And if we have to come back and raise rates again, we will. So again, this up here tells you that they're pausing. They will no longer say some additional policy firming may be appropriate in order to get to our 2% inflation. They're going to say, we're going to monitor this data, and if all looks good, we'll stay right here. But if it doesn't look good, we will come jack those rates up again. That's how they're going to sound tough, which I don't know if that sounds tough to you. It kind of just sounds like big words. But that's what they're going to use to tell people, and mostly the analysts out there, we will be tough and further tougher if we need to, but for the moment, we're going to leave it there, realizing we need to let the data kind of soak in and see how things go. So there you go. Oftentimes, when it comes to these different bills and some of the things that Congress has passed, Secure Act 2.0, and all this great stuff, the CARES Act, and everything that went along with that, oftentimes I'll do a class for clients where I'll just show the screen like that and go, this is what that means. This is how Congress says these words, and I'll just dissect it in real time. I think I did one publicly for you guys where we just search for words, read the sentences, and go, okay, so the way they write this is what they mean, and this is what the law will be. Well, the same is true for the Fed. I don't often share this kind of stuff because I don't think it's is it interesting to you? Did I just put you to sleep? Are you like halfway through your drink now at the moment? But I thought this one's important because we know that stocks do well at the end of Fed rate hikes. The Fed doesn't want that. If they go in and say, pause, we're not coming back to raise these rates, stocks would blast off, which would not help inflation. So what they need to do is they need to come across as, we're happy with this. We feel like we did a good job because it's going to slow you guys down. You guys are going to stop spending money, right? But don't make us come back and do it some more. They're trying to put a lid on the movement in the stock market. And for that reason, that's why almost every analyst out there at the moment, besides I think Wells Fargo, says the market's just going to finish right here. Right basically where we're at, within a couple hundred points plus or minus of right now, 4170 or wherever it's at. That's where we're going to finish. We may have a spurt up, we may have a pullback, we may have a rally, but ultimately there's a lid on the market, being the Fed, that's going to continue to use their language, it's called jawboning if you want to sound fancy, to keep a lid on the market. That's what they're trying to do. So we'll see what happens. We will be watching every day. Does your financial advisor do things like this? Are they always watching every word of everything that comes out? A lot of people think I don't sleep. That's partially true. I don't really sleep a lot. But if they're not doing that, if they're not teaching you, if they're not educating you and giving you the breakdown in layman's terms of how things work, I hope you'll keep us in mind at Jazz Wealth. We trying to do things differently. And we have the backing, of course, of Goldman Sachs. And, we're not just some peon over here, but we're a small fish in a big pond. And we'd love to have the chance to work with you. So I hope you'll keep us in mind. I will spare you the rest of the geeky details and share more on The Closing Beat. That's a live show that we do every day at 5 o'clock Eastern Time, and hope to see you there. I'm going to take my C+ Westward Whiskey on and go back to work. All right, guys, Enjoy. Thanks.